In this video, we're going to learn how to estimate bottom-up betas. You probably are looking at this crazy diagram that I drew in quotation marks to describe what a bottom-up beta is. But I believe you've all seen bottom-up betas, or at least talked about levering and unlevering betas, which is part of the bottom-up process in Finance 3824. And so the idea behind a bottom-up beta is that you are starting with a beta that captures the business risk and only the business risk of the industry that your firm operates in. If your firm operates in more than one industry, then you need more than one average industry beta. And again, I said the beta should a beta that captures the business risk and only the business risk. Now, betas are a product, you could say, of your firm's business risk, operating leverage, and financial leverage, right? The amount of debt that the firm uses. We don't really know a good way to peel off operating leverage, and luckily the operating leverage of a firm in a given industry is likely to be similar to the operating leverage in another firm in that same industry. So perhaps the industry average beta will represent, or we're expecting it to represent, the business risk including the operating leverage, and we are going to take off the financial leverage portion of it, right? So the idea is that we start with a bunch of regression betas in a particular industry, okay? And a regression beta, you've already calculated those. You didn't adjust anything for your firm's debt. You didn't adjust anything for your firm's industry, right? So that is a full strength beta, so to speak. It's levered, right? It has the effect of financial leverage, and it is an accurate representation of what happened to your firm in the past relative to the market, right? How your firm moved with respect to the market over the past 5 years, which is great. That's a great thing to know, right? But what we're really trying to estimate is what's going to happen over the next 5 years, right? Over the next 5 years. That's where I should put the emphasis on next, not the last 5 years. And so probably a better estimate for that is not what just happened to our firm, but what happened on average to firms in our industry. And so we start with those individual firm regression betas in our industry. We're going to take off the leverage of each one of those. And I say we, but the truth is this part of the process, our good friend, Professor Damodaran of NYU, is doing for us, right? He, on his website, has provided us with data where he is taking these regression betas from many firms in a given industry, as many as he can find. Then he takes off the financial leverage using the formula for unlevering betas, which is dividing by, you take the beta and you divide by 1 plus 1 minus t times debt over equity. Right? The 1 minus t, of course, is to adjust for the tax deductibility of debt, and the debt equity ratio is how we adjust for leverage. Now, when we're unlevering, we divide by this factor. When we are relevering, we will multiply by this factor, right? So we unlever all of those betas, and then we using each firm's debt equity ratio and tax rate. And then we take off the cash we're going to divide by, or again, Damodaran does this for us, divide by 1 minus the balance of our cash plus short-term investments divided by the market value of our firm. Now, why are we doing this? We've talked about why we're taking off the financial leverage, right? Or maybe we haven't actually talked about why we're taking it off. We want to get down to the business risk only beta, right? And while business risk is assumed to be similar for all the firms in a given industry, financial leverage is not assumed to be the same for all firms in a given industry. It is likely to be similar because some firms in a particular industry have similar fixed asset needs, and needs for fixed assets are usually what drive needs for financing, right? But of course, as we know, how much debt a firm can afford to use is based on more than just the industry that they're in, right? It's going to be based on how old the firm is, how steady its cash flows are, what its credit rating is. And so all of these things mean that firms' financial leverage can vary quite a bit, even if they're in the same industry. So we're taking off the financial leverage. And then the other thing that affects our betas is our cash holdings, right? Cash is a zero beta asset. In other words, its value does not change as the market goes up and down, right? And so firms that hold a lot of cash are a little safer than firms that hold less cash, right? Firms that hold a lot of cash are able to more easily weather the ups and downs of the market than firms that hold little cash. So we adjust for that by dividing this. Now, once we start here, this is a beta, full-on beta. We take off financial leverage, and so then we call that an unlevered beta. And now we're going to take off cash, so we call it an unlevered beta corrected for cash, right? And so that's what we need, is an unlevered beta corrected for cash for each of the industries in which our firm operates. And so our source for that data is Professor Damodaran's website. So we're going to go on to data. Of course, we want current data. And we're looking for levered and unlevered betas by industry. Okay? And so here we have all of the industries for which he has calculated a beta. And over here we have the betas that we want, the unlevered betas corrected for cash. Now, I said that we need a beta for each industry in which our firm operates. Now, you were all grouped into industries, and so you have an industry name that should be the primary industry in which your firm operates. But many firms operate in more than just their primary industry, so if we want to see what those industries might be, one source of that information is the data that we've already pulled from Mergent. If you look at business, it will tell you the NAICS codes and the SIC codes that apply to your firm. So we can see that in both cases, software is identified as the primary industry in which Microsoft operates. But then there are some minor differences between the industries as identified by NAICS, whatever you want to call it, and SIC, right? But we've got basically software, we've got computer peripherals, and we've got computer-related services. Now, in order for me to use this information, I will need to be able to do two things. First, I need to be able to identify industry betas for each of these industries. Let's say I wanted to focus on SIC codes, right? I need an industry beta for each of these. And I would also need to be able to assign weights to each of these betas. For example, if I'm going to use 3 betas, I need to be able to say, well, the software beta is, or the software represents about 70% of my firm, computer peripherals is about 20% of my firm, and computer-related services is about 10% of my firm, right? And those percentages become the weights that I use to get my weighted average beta. The best way to determine our weights is by using either revenues or operating income. In fact, I should have said operating income or revenues. Operating income is preferred, but operating income can be negative, and when it's negative, it makes the weights meaningless, right? You can't weight something by negative 20%. And in that case, if I had any of my segment operating income negative, then I would have to use revenues instead for my weights, right? So if I look at segments here, I can see how Microsoft reports their segments. And I can see that in 2015 and prior to, Microsoft reported their segments as having 2 segments, devices and consumer and commercial. And for whatever reason, in 2016, they changed the names of their segments and presumably the way they divided up the business amongst those segments into these 3 segments. But the problem is that looking at these segments and looking at these industries, it's not obvious to me which of these segments correspond to those industries. Is productivity and business processes software, or is it services? Or, I mean, I guess it's not periphery, right? Intelligent cloud, is that services or is it software? If I were a little more computer savvy, maybe I could put those in better. Personal computing, could be the hardware part or the peripherals, but it could be software related as well. So it's, difficult for me, given the data that I have, to accurately match up operating income or revenues with these industries. And of course, when I look at Damodaran's industry list, I can find the SIC industries, computer services, computers, peripherals, and, well, software he has divided into 3, right? But I don't see any of those segment data names. So, as much as I'd like to accurately divide my beta into 3 industry betas to match these 3 industries listed here, I just don't have the data to accurately do that. So what I've done is tried 2 approaches. First, I have my first approach is to just use software. That's my primary industry, and in this case I've assumed it's system and application, right? Because Microsoft does so much more than entertainment or just entertainment, and so much more than internet, which I'm assuming is like search. And when I look at Damodaran's website, I see that system and application has a 0.99 unlevered beta corrected for cash, right? And that's here. So I have pasted up here. I went ahead and pasted all of these because I was considering them all. But I've pasted, copied and pasted from Damadarn's table the industries that I was interested in. And here is my unlevered beta corrected for cash. Okay, so that's where I start. Now, the other things that I'm going to need for this estimation are 3 items from previous work: my market value of liabilities, or we've been calling it the market value of debt, right? As we know, debt is a shortcut way to say liabilities, but the truth is there are liabilities that are not debt, right? Debt is a smaller subset of liabilities. Market value of equity, which we've also estimated or calculated, and the cash holdings from our most recent balance sheet. So in my case, market value of liabilities is from my market value of debt and equity tab, and so is my market value of equity, right? So I can go there, and I've linked to these using cell references. And then the cash holdings, you'll notice 2 things, please, about this formula. First, I have added 2 things together. Microsoft, as you know, is one of those firms that hoards a lot of cash. And firms that do hoard or hold, however you want to say it, they don't keep all of their cash in a cash account. They put a good chunk of their cash in some kind of short-term investments that enable them to access that money quickly and without much loss in value, but also enable them to earn a little bit of a return, right, while they're waiting for either a good project to come along or for the U.S. government to lower corporate taxes so they can, well, I say can, so they are willing to bring their cash home from abroad. They certainly have the ability to do it at any time. Whether they have the motivation or not is another question. Okay, so I go to my statements. I look for my balance sheet, and here I have cash and cash equivalents and short-term investments. So those are the 2 things I've added together. Of course, Microsoft, being really very helpful and transparent when it comes to its statements and 10K, has already added it for me. So I can either use number 103 in this case, or cells 101 and 102. And so I go back to my bottom-up beta, and I've used cells 101 and 102. And then please note that I've multiplied by 1,000 because, as you know, Mergent Online statements are all shown in thousands. And since my market value of liabilities and equity are shown in full force, so to speak, I need to make sure that my cash holdings are also in full force, or the actual number. Okay, and so then with these 3 numbers and my unlevered beta corrected for cash for the software industry, I can calculate Microsoft's unlevered beta. The unlevered beta is also known as the asset beta, right? Because it's our estimate of the market risk of Microsoft's assets, right? We're ignoring at this point how those assets are financed. We're just looking at the market risk of those assets. And that includes Microsoft's cash because we're adjusting for cash here. And how do we do that? We take the unlevered beta corrected for cash and we multiply by 1 minus the cash holdings divided by the market value of the firm, which is the market value of liabilities plus the market value of equity. If we also had preferred stock, we would also add the market value of preferred stock. Okay? And so there we have our asset beta. Now, notice that as we move from the unlevered beta without cash to the unlevered beta with cash, right? Really, the only adjustment we've made here is to add back Microsoft's cash holdings. We've got an industry average business risk beta, and then we add back Microsoft's own cash holdings. And so the beta goes down, right? Because cash is a zero risk asset. So the beta goes down. The next thing we need to do is lever up our beta. In other words, add on the financial leverage of our firm. And for that, we need the debt equity ratio website. And so back I go. For that, our market values of debt and equity. And we need our firm's marginal tax rate. And for this, we are also going to go to Damodaran's website. And so back I go to the website. Again, this is from the home page. And as you can see on my Chrome, I use Damodaran so much that it's a tab here or a bookmark. But of course, you can get there by either Googling Damodaran or by typing in this URL. Go to Data, Current Data, and now we're looking for Tax Rate by Industry. There it is. And there is our table. And again, it's all the same industries that we have betas for. You'll notice he gives us 3 different tax rates. So which one do we use? If your firm has any negative income over the past 5 years, you should use the average across all companies, because this is the average that would include companies that lost money and that made money, right? So that's a better average, right? And you can see in all cases, the average across all companies is lower than the average across only money-making companies. This makes sense to use this one, right, if you've had losses, because you will be able to carry those losses forward, and that will lower your tax rate somewhat in the future. If you have no losses over the past 5 years, you can really choose one or the other. I believe we have talked about the difference between aggregate effective tax rates and average tax rates. Did I say that right? Aggregate effective tax rate versus an average. I mean, they're both kind of like averages, but the way they are calculated is different. I can't tell you that one is better than the other. And you can see that although most of the time it looks like the aggregate effective tax rate is higher, there are some occasions when it's lower than the average. And sometimes, evidently, when it's right on the money. And of course, you also have the option of using your firm's effective tax rate as reported in the 10K. But again, although on the surface it may seem like using your actual firm's data is a better estimate, remember that we're estimating for the future, not trying to describe the past. So the very specific thing that happened to your firm last year or over the past 5 years may not be as good an estimation of what's going to happen to your firm over the next 5 years as an industry average would be. So if you have not lost money over the past 5 years, you'll choose one of these. And honestly, I can't give you any theory that would tell you which one is better. If you're trying to be relatively conservative, you might want to overestimate the tax rate, and so you might want to pick the one that's higher. You could always take an average of the two. That doesn't make such a big deal here, given that most of them are pretty close together. But taking an average is always a reasonable way to make a choice, right? When you don't really want to make a choice. Okay, so now we've got a tax rate, and again, I put in a screenshot, or I copied and pasted actually, from Damodaran's table to show where I'm getting the tax rate from. And you can see that I chose to use the average across only money-making companies. Thinking back on it now, given that Microsoft is such a large company, and in the aggregate effective tax rate, the large companies are probably have more of an impact on the aggregate. This might have been a better choice, but they're so small. The difference is so small that it probably doesn't matter. And in fact, I can see if it matters or not by just entering 0.24. Let's see. 0.8684 is my beta with the smaller tax rate. 0.8665 is with the lower, so really the change was only in the third and fourth decimal place, so big deal. And rounding up, if I'm rounding to 2 decimal places, there's no difference at all. So I know that it's not really necessary for me to fret over my choice here, because the difference doesn't, or the choice in inputs doesn't really make a difference in my beta. Okay, and just for fun, I looked at how much my beta changed because of debt. So I divided the levered beta by the unlevered beta and then subtracted 1, and I found that it increased my beta by 8%. Now, Microsoft, when you look at market values, their debt is not that much, right? In fact, the debt equity ratio is only 10%. In other firms where your liabilities are a higher percentage of equity, you would see a bigger change in your beta. Now, the levered, also known as the equity beta, is the full force, full strength beta that you should be using as one of your betas in your inputs. Later on, when we talk about sensitivity analysis and changing inputs, you will use this as one input, and you will use your regression beta as another beta input. You will not use an asset beta or an unlevered beta corrected for cash, right? These do not represent the total market risk of Microsoft. This represents the business risk of the software industry, and this represents the business risk of Microsoft, but only when we account for the debt do we have an accurate representation of the market risk of Microsoft. Okay, so this is your beta. We will speak in class about the whether your base case should be your bottom-up beta or your regression beta. But the bottom line on this is that most of you should be using your bottom-up beta as your base case. Why? Because it starts with an industry average, which is a better estimate of the future. The only people who would have a good case, in my opinion, for using your regression beta instead of your bottom-up beta are those who feel very unconfident. Oops, inconfident? No, what? Unconfident? You lack confidence. There we go. Those who lack confidence in your choice of either industries to represent your betas or in how you've weighted